Hey there, have you ever wondered how people make money in the stock market, or why some investors seem to earn huge profits while others struggle? Today we're going to take a journey through the stock market, step by step, so that even a complete beginner can understand it. By the end of this video, you'll see the stock market in a way that feels simple, exciting, and full of opportunities. Imagine walking into a huge marketplace. Instead of fruits, clothes, or gadgets, this market is full of pieces of companies. These pieces are called stocks, and buying one gives you a small ownership in that company. Owning stocks means you're part of the company's story. You share in its profits, its growth, and sometimes even its challenges. Let's start with a story. Meet Alex, a young professional who wants to grow his savings. Alex has heard that the stock market is a place where he can make his money work for him, but the market feels overwhelming: numbers, charts, and stock symbols everywhere. How does someone like Alex begin? The first step is understanding what a stock really is. A stock represents a small share in a company. If the company grows and earns profits, the value of the stock can rise. Some companies also pay dividends, which is like a small reward given to shareholders from the company's profits. Owning a stock means you are literally a part owner of a business. Next, let's talk about the stock exchange. This is the platform where stocks are bought and sold. Think of it as a huge digital marketplace. In the past, people shouted bids and offers on trading floors, but today most trading happens online. The stock exchange connects buyers and sellers, making sure the process is smooth, fast, and secure. Alex decides to start small. He picks a company he knows and likes, a tech company that makes smartphones. He buys a few shares, becoming a tiny part owner. At first, the value of his investment goes up and down. Some days it's higher, some days lower. This is called market volatility, and it's normal. Understanding that prices fluctuate is key to becoming a confident investor. Now, let's explore why stock prices change. The price of a stock depends on supply and demand, how many people want to buy versus sell. If more people want a stock than are selling it, the price goes up. If more want to sell than buy, the price goes down. News, company earnings, economic trends, and even global events can influence these decisions. Alex learns about long-term investing. Instead of reacting to every price change, he focuses on companies with strong fundamentals, steady profits, good management, and growth potential. Over time, even if the market fluctuates daily, his investment grows as the company succeeds. Imagine a world where Alex decides to invest in multiple companies: tech, healthcare, energy, and consumer goods. By spreading his money across different sectors, he reduces risk. If one company struggles, others may do well, balancing his overall investment. This is called diversification, a key principle for every investor. Alex also discovers indexes like the S&P 500 or NASDAQ. These are collections of top companies that represent the overall market performance. Instead of picking individual stocks, beginners can invest in these indexes to participate in the market's growth safely. Understanding stock basics is not just about buying and selling. It's about learning to read company reports, understanding profits, losses, and how businesses grow. Alex starts following a few companies, learning their stories, and paying attention to their earnings reports. Slowly, the stock market becomes less scary and more like a world of opportunities. And here's a secret: patience is crucial. Stocks are not a magic lottery. Investors who succeed often stay calm during market ups and downs. They focus on the long-term growth of companies rather than daily price swings. Alex learns that knowledge, strategy, and patience are more powerful than luck. By the end of this part, Alex feels confident. He knows what a stock is, how the market works, and why long-term thinking and diversification matter. He's ready to take the next steps in his investment journey, prepared for the excitement, challenges, and opportunities that lie ahead. Hey there, welcome back. In the last part, we met Alex and learned what stocks are, how the stock market works, and why patience and diversification are so important. Today, we'll go deeper. We'll explore the types of stocks, how trading works, and what beginners need to know to start investing safely. Imagine Alex sitting at his desk, laptop open, staring at the stock market app. There are so many numbers, charts, and stock symbols that it feels overwhelming. But instead of panicking, he reminds himself of the basics he learned. Every stock represents a part of a company. Every number tells a story. Every chart is a way to understand the market better. Alex first learns about stock categories. There are blue chip stocks, which are big, stable companies with a long history of consistent performance. Think of companies like Apple, Microsoft, or Coca-Cola. They may not grow explosively, but they provide stability and often pay dividends. Then there are growth stocks, companies that may be smaller or newer but have the potential to grow rapidly. They can be riskier because if the company fails to meet expectations, their stock price may drop. However, if they succeed, the returns can be substantial. Alex realizes that balancing blue chip and growth stocks is key for building a strong portfolio. Next, Alex learns about dividends. Some companies share a part of their profits with shareholders as dividends. It's like getting a small reward just for being an owner. Dividends can be reinvested to buy more shares, compounding wealth over time. Alex is excited because he now understands that owning stocks can provide both growth and passive passive income. With a better understanding of stock types, Alex dives into how trading works. Buying and selling stocks happens through brokers or trading platforms. In the past, brokers were human agents who made trades on behalf of clients. Today, most trading is digital, fast, and accessible to anyone with an internet connection. Alex learns the difference between a market order and a limit order. A market order buys or sells immediately at the current price, while a limit order sets a specific price at which he wants to trade. This small detail helps him avoid mistakes and ensures he doesn't overpay or sell too cheaply. Next comes the concept of risk and reward. Every investment has risk, the chance that the stock price may drop. Alex realizes that higher potential returns usually come with higher risk. This is why diversification is important. By spreading investments across different sectors and types of stocks, he can reduce risk while still aiming for growth. Alex also explores index funds and ETFs, exchange-traded funds. These are collections of stocks, often tracking a market index. Instead of picking individual stocks, beginners can invest in these funds to gain exposure to many companies at once. It's like buying a basket of stocks instead of a single fruit, safer and less stressful for someone new. Then Alex discovers technical analysis. Charts show past prices, trends, and patterns. Some investors use these to predict future price movements. While this is helpful, Alex learns that beginners shouldn't rely solely on charts. Understanding the business, earnings, and long-term potential is more reliable for steady growth. Alex also learns about common mistakes beginners make. One is panic selling when prices drop. Another is chasing trends or buying a stock just because everyone else is. By learning patience, research, and long-term thinking, Alex can avoid these traps. Another important concept is compound growth. Imagine Alex invests $1,000 in a company that grows 10% each year. After 1 year, it's $1,100. After 10 years, it's over $2,500. Small, consistent growth adds up exponentially. This is why starting early and staying invested matters so much. Alex practices by creating a mock portfolio with imaginary money. He tracks stocks, notes changes, and learns to make decisions without the pressure of real money. This helps him build confidence, understand market behavior, and develop strategies before investing for real. Are you thinking about entering the stock market? Do you want to know how to earn money from it? If yes, then this video is just for you. Today, I will guide you through 5 essential steps that will help you start your journey in the stock market and truly understand it. By the end of this video, you will know how to taste the stock market, feel its movements, and gain confidence to invest. The very first step is to have the right belief system. Many people avoid the stock market because they have seen others lose money. Maybe your parents, relatives, or neighbors have invested and faced losses, and that has made you hesitant. Many people think the stock market is risky, unpredictable, or even like gambling. But the truth is, the stock market is not a casino. It is a place where you buy shares of companies. When a company earns profit, the shareholders earn profit too. It's as simple as that. You need to fix your mindset and understand that the stock market is a tool to grow your wealth over time. You don't need a commerce degree or a special qualification. Even if you have studied only till the 10th grade, you can learn this. The key is to believe in the process, not in shortcuts.